Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, September 30th, 2025. Hope everyone's having a great week. So, as always, we'll start with the executive summary from today's Lit Off Morning Note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following KISS or Dr. Mo, you need to be a client of 42 Macro. So, today's key macro question is why should investors pay more attention to the U.S. housing market? Our answer: the strong negative impulses in nationwide house price inflation featured in the latest FIFA and Case-Shiller data support our call for structural regime change at the Fed. The strong negative impulse in building permits, the second longest leading indicator of the housing cycle behind builder sentiment, also supports our call for structural regime change at the Fed. Recall that the housing market is a persistent leading indicator of the business cycle, according to the 42 Macro Business Cycle Model. At best, the housing cycle is currently mired in a moderating downturn. Moreover, the lock-in effect continues to restrain the existing home sales market, which is why new home sales are currently at an all-time high of 17% of the total. New home supply remains cyclically and structurally depressed, as the 3.3% share of residential fixed investment in GDP has only been lower in the years immediately following the post-GFC housing bust. Interestingly, U.S. households currently expect to earn, spend, and be taxed at above trend rates in this income-driven business cycle, while credit availability remains a noteworthy laggard that we anticipate will be addressed through policy intervention in the coming quarters, most notably via deregulation, lower interest rates, and, if necessary, MBS QE. While the lack of credit availability has made the U.S. more resilient to economic volatility, it has made the country less resilient to political volatility. Recall that residential mortgages account for 2/3 of total U.S. household debt. If the Fed does not become more acquiescent to fiscal dominance, then the housing market will not heal in either supply or demand terms. Moreover, with AI already eliminating jobs for recent college graduates, more bad monetary policy outcomes risk a lurch towards democratic socialism on a nationwide basis. What is the key risk to the economy and asset markets if the Fed does not allow the housing market to heal because of its arbitrary 2% inflation target? Hint, paradigm D, which is the print phase of the limited mix of policy responses to the growing geopolitically driven supply-demand imbalance in the Treasury bond market. For example, paradigm A was Biden's, fiscal largesse, monetary largesse economy. Paradigm B was the cut phase that was very short-lived with the Doge experiment. Paradigm C is what we're currently in now, was to try to outgrow the debt problem. And then eventually paradigm B will be to eventually just print our way out of the debt problem, or at least print our way to address the debt problem. We probably, many years away from paradigm D, but this paradigm C experiment could be multiple years in the making. And so I want investors to be aware that, having altered that view and that theme back in April, it's still pretty early in the context of paradigm C. And so lastly, in our view, it is highly likely the next Fed chair understands this dynamic far better than Jay Powell, specifically what we mean by the risks to the political cycle if we do not fix this nationwide housing crisis, or housing emergency, as the administration is increasingly inclined to call it. So transition to our 42 Macro dashboard. As always, I'll wrap up with a question from our community. This was not a question, but a comment. I thought it was important to highlight. It says, titled, "You've Earned My Trust." It says, "Dear Darius, I've been following your work for a couple of years, having previously tracked the hedge fund you were part of. Your intelligence and insight have always stood out to me. Growing up in a family of 5 in a single studio apartment, I've worked hard for every dollar I've earned, which makes it difficult to trust others with my money. Over the years, I've found myself aligning with your perspectives, and though I consider myself a thoughtful investor, my risk-averse nature often leads me to play it safe, sticking to cash and hesitating to act. Your well-reasoned approach has given me the confidence to take calculated risks and trust your process, even when the markets temporarily move against me. Thank you for your exceptional work. At 36, I see myself as a lifelong supporter of your insights and vision. Your mission deeply resonates with me. I hope more people discover the value of your products. Keep up the good work." So I just want to say, super blessed by this super very kind compliment. This is exactly what we do for a living. This is exactly what I do for a living. This is exactly why we started this company, is to help this person, this avatar, experience better outcomes with regards to their investment journey and then ultimately, their financial freedom. And again, I spent the first decade or 12 years of my career, slightly over 12 years, the first 12 years of my career essentially using my skills, my intellect, my thought process, my talents, my God given talents to help make previously existing rich people more rich. And that was great. I made a ton of money doing that, and it was fantastic. But the reality is as I got older and older, and I started to realize and came more close, my walk with Christ became more closely aligned with how it should have been. I started to realize that I wasn't doing the right thing for society, and so we built this company to essentially help address that, which is, instead of just making the rich people richer, why don't I make everyone richer with these skills? And that's exactly what we've been doing since we launched this firm, and that's exactly what we've been doing at an accelerating level rate with the advent of our KISS model portfolio, which we introduced back in January of 2023. Obviously, demonstrably outperforming most hedge funds since then on an absolute and risk adjusted basis. No, I have no qualms about saying that because it's true. We introduced our discretionary risk management overlay to help our hedge fund clients keep up with KISS back in the fall of 2023, and they've been obviously benefiting tremendously from the signals that we provide there as well. So, like I said, super proud of what we built here, what our team is building. I'm really grateful for the opportunity to contribute to the investment journey of folks like this, folks like, who grew up, obviously like myself. This person grew up in a studio apartment with 5 family members. I grew up at the best of times. We were in at the absolute best of times, we were in a 2-bedroom housing project with our family of 4. At the worst of times, we were homeless, living in vans, living in homeless shelters, living in motels. And so, I certainly have a lot, I certainly have a lot of life experience as someone who grew up like that. And naturally, as a risk averse person, and certainly as a person, but also as an investor, when you grow up, you see your friends, get murdered by gang violence, and you grow up and you see your family constantly getting evicted and living on the streets. You realize you develop a level of risk aversion that is not healthy as an investor. And so, it's probably why I'm a risk manager for a living, honestly. If I think about it, kind of just thinking out loud, like that's probably why I'm so focused on risk as a risk manager. But I don't want people to be so myopically focused on risk that they fail to maximize upside capture in bull markets. That to me is one of the biggest risks to everyday investors out there, is the failure to maximize the upside capture in the bull markets. And that failure is the single greatest risk to your retiring on time and comfortably. So many people get triggered into thinking the single greatest risk to retiring on time and comfortably is blowing up their portfolio in a market crash. And to be fair, that is true. It's a very important risk. In my opinion, they're equally important. The failure to maximize upside capture in bull markets, or the failure to adequately manage risk heading into a bear market. Those, in my opinion, they're identical. Risk works in both directions, and it's always a function of your legacy positioning. And so this is why I preach every single day here in these macro minutes, and every single thing that we do here at 42 Macro, that our number one job as investors is to stay on the right side of market risk. It's not to be, 100% bullish or 100% bearish, or to overtrade our accounts or do this or do that. It's just participate in what the market is trying to price in, and or get to the safety of cash and on the sidelines when the market is trying to price in something hazardous to your financial health. So I think we do a great job for customers like this, and obviously doing a great job for myself. I use KISS to manage my entire liquid net worth as someone who's highly risk averse and is highly convinced and highly certain that I am not going back to the poorhouse where I came from. You can trust that someone who eats what they cook to such a high degree that this stuff is highly effective at managing risk for folks like myself and folks like this customer. So I'll stop rambling and just say thank you to this person. Thank you to all of our thousands of members around the world on Team 42 who shower me with this kind of wonderful feedback that gives me the power and the energy to do this grind on a daily basis. And I tell you what, it is a grind. So I appreciate y'all. Just say thank you. I'll wrap it up there. We'll catch you back here tomorrow. Cheers.